think Robotti and Company is a community of stock pickers. And by that, I mean that there's two key elements. That's process and people. The first is process, and the process is valuation matters. And there's no substitute for bottom-up stock research. And that's what we do. We look for companies where the present value, the future cash flows far exceed the trading price of the stock. And we think today is a particularly opportune time because the market is giving us plenty of opportunities. The second is people, culture. The thing I'm probably most proud of in the 39 years since I started the firm is that we've been able to attract, retain, develop, be introduced to like-minded stock pickers. A story about 7 years of feast and 7 years of famine. And of course, that's what stock markets regularly do. There are cycles that markets go through. One of those cycles is the economic environment favors one group of stocks versus the other. So whether that's the growth stocks sometimes, whether that's value stocks other times, it does clearly tend to go in cycles. Of course, instead of a 7-year period where we've had feast and famine, it's really been a 14-year period post the financial crisis. And that's because the economic backdrop during that period of time, strangely, for an extended period of time, has really been relatively monolithic. And the key attributes that we would highlight are it's been a relatively low growth economic environment. Inflation has been extremely low over that period of time. And as a result, interest rates have been low to nothing to negative over that period of time. In addition, you've also had the fixed income market has been in a 40-year process where rates have only come down. And so a dramatic bull run in the bond market. What's happened is we think that many investors have come to think this is the new normal. Capital is allocated thinking this is not a cycle. This is not the end potentially of a significant, extenuated, elongated cycle, but instead the new norm. And we think that that's what sets up the opportunity for us. What we actually phrase it is it's the myopia of linear thinking. Things have gone on so long that people are convinced this is the new norm. You know, what better anecdotal evidence could you have that maybe that presumption is wrong, other than you look at the cover story from the Bloomberg Business Week, inflation is dead. Of course, we've highlighting the fact that when those cover stories run, it's an interesting time that potentially is marking the turn in a macroeconomic situation. It's a quote that we love and we think is so apropos, and it's from Rüdiger Dornbusch, who is a German-born economist who taught at MIT. And he highlighted this idea that in economics, things take longer to happen than you think they will. And then they happen faster than you thought they could. And so we think that that's playing out in so many ways today. The things that our bottom-up stock research had indicated to us in terms of businesses, and therefore some portion of the economy, indicated that there were trends underway that hadn't manifested that were very interesting and potentially would lead to a change in a rotation. And then, of course, we really would point out that in the last year and a half, things have adjusted very quickly because there really is a disruption from what the past monolithic economic environment has been. Now, we would point out that much of the market is projecting that inflation will be tamed and relatively soon will return to a relatively benign inflationary environment. And that's priced into many things today. So we think that there's a risk that the markets are in denial, and therefore they haven't really started to adjust yet fully to where we think are, because we do think that there's reasonable chance that inflation may moderate, yes, but does it moderate where it was? Maybe not. And if not, that's different than most people's presumptions that's priced into securities today. That's what we're highlighting clearly this significant shift in the macroeconomic environment that may be transitory, that we have reasons to think, no, there's more persistency to it than people believe. And that's causing significant changes in valuation. And you've seen that, right? You've seen stock and bond markets, this year have extremely difficult times. And so therefore, that's relevant. And that's what we also think. There's a lot of conversation that goes back to, well, the trend has happened last time, is this happens and that happens. So therefore, people have plenty of information and therefore try to impose those situations onto what they think will play out today. But we believe the idea that there's no substitute for thinking. When you intuitively think through, that is a critical element that potentially comes to a different conclusion than the market has today. The important thing, though, is for us, the North Star, and for all investors, the North Star is valuation. It is the cash flows of businesses that will eventually determine the market price of those securities. And what we have is a universe of companies that we know well, have studied for a long period of time and have conviction about the sustainability of the earnings they have. And they've demonstrated those earnings over the last year or two. And because of those earnings, the financial position of those companies today is extremely strong. So many of those companies today have net cash on the balance sheet. In addition, trade for single-digit PE multiples. So clearly, on an absolute basis, extremely compelling investment opportunities. What also has driven this is the movement of capital. So much capital is now invested in passives, right? Passives are a larger component of the total equity market. And what happens with passive investing, right? It's not bottom-up stock research. The thing we do and continues to do and continue to perfect throughout the decades is something that we think is the differentiator. And the opportunity is set up by the fact that you've got such an elongated period of time where the best securities perform so well, and they did have a strong economic environment behind them that facilitated that, but the valuation and the capital continues to flow into them and out of other securities. And therefore, that's what we have now. We think there's a disruption and a rotation from the market leadership. And in that process, instead of owning 25 stocks that will outperform the aggregate of all other investments, those things are changing. And therefore, there's a dispersion that's happening. And therefore, that's why we think the opportunity. We have the little chart here that does highlight, the cycles that investors go through in this process. And we think that much of the money, because this year continues to come into passives, right? People are thinking, oh, it's down some, so let me buy the dip. And the question is, are you buying the dip or are you buying the next leg down? And therefore, we think the market is largely in denial in terms of those things that have performed well for such a long period of time, that they've attracted so much capital and have valuations that put them at risk. What we think the 40-year juggernaut in the bond market is a thing of the past, that free money, Fed money, plentiful money is over, that the price discovery is reasserting itself, and it's only beginning. So people are still in denial or apathetic on cash flows. The continuation and the ability of those businesses to generate those cash flows will convince investors and attract capital. Therefore, active management, we think, is extremely well positioned, and that's something that's a universality across all of our portfolios and all the people here at Robotti. All of our approach, we're in the right place. We know the companies. We've done the work on them. We understand dynamics, and you could see, obviously, the significant attractive valuations today. Ran back in 1934. And the point he's making here is that volatility in businesses and cycles mean that at points when the business is difficult, the market reacts to that and depresses the public security price dramatically. So that means that you can buy a business frequently that is a substantial discount to what it would cost to build that business, given the difficult economic environments a company is going through. Of course, you want to make sure it's not a buggy whip, so that therefore there really is a recovery in that business. Schumter talks about, the concept is kind of Mr. Inside, Mr. Outside. So the first one is Mr. Outside, and that is what the market does and how it discounts securities and gives you an opportunity to buy businesses. Here, what it talks about is when those businesses are going through difficult times, what happens in those businesses? And so that's when those businesses are in a difficult situation, there's a cathartic process that goes on. There's right sizing, downsizing, and consolidation. So therefore, you start to fundamentally change the supply-demand dynamics of that company and that industry to improve the earnings power of the assets for those remaining players. The consolidation adds to that. What we'd also highlight is, once again, this extended period of economic environment in the backdrop has meant that the down cycle has been extenuated. So therefore, instead of recovery that normally might have happened, you've had repeating downsizing. So there's been a substantial underinvestment in a number of these industries and businesses that we're invested in today, so that in many cases, there's even a structural change to the business. And therefore, the volatility and the cyclicality are substantially less, at least for an extended amount of time, because there's a hesitancy for capital to come back in. In cyclical businesses, it's well known that the cure for high prices is high prices, because that brings in new capital and therefore destroys the returns, or at least moderates the returns. There are plenty of reasons in these businesses, given how they have consolidated down, that are restricting the normal flow that normally happens here. So what we also do is, we're not just looking to buy a business that's going through a difficult time and has that cathartic process, is consolidating, is restructuring its business and it's being discounted by the market. But we also look for a business that has something about it that's different, whether that's a product, whether that's a service, whether that's a management, whether that's an owner, or in many cases, all of those factors, and therefore facilitate being able to extend the recovery and potentially have a different transformed business given how management responds and what it's done. And that's what we've done repeatedly.